In 2008, the world stopped spinning. Everything was out of control. The financial system was beyond weak. Central banks went into territory that they never would have dreamed. Today, we are in the same places, navigating through unknown to the masses. This will not end well. Ignorance is not bliss. You came here for the truth, so let me unveil that for you. Today, we are going to talk about the financial crisis part 2. If you look at what had happened in 2007 leading into 2008, there was a lot of breadcrumbs that we could have been picking up on, but the masses had no clue. Why? Because they were buying 2, 3, 4, 5 homes, and they figured, hey, as long as this continues on, I don't need anything to be worried about. There's no reason. I have everything going. The prices of homes will go up forever, and the financial assets will continue this magnificent rise forever and ever, and I can rest easy. But of course, we learned the hard way there. Now, today we've got some serious issues going on with the commercial mortgage-backed securities, with commercial real estate, with what's happening with hotels. And that's where I want to begin today's video, because hotels are obviously down. Tourism is down. This has created a problem not just for the people in those jobs, which we'll talk about here, but of course, you look at the actual commercial mortgage-backed securities where you have some of these that are squeezed into a few, and that is being heavily basically battered by all of those different derivatives that are there, and people are looking at them like licking their chops because they know that this is going to be one heck of a trade, and it's not going to look good because these businesses are defaulting on their debt. They're going bankrupt, and of course that's going to be an issue. We can't turn away. I see the comments all the time talking about, stop doing what you're doing. This is not good. It's not helpful, but somebody's got to do it. Somebody has to tell you the information that you probably don't want to hear. If you want to get stocks, if you want to look at, the next Amazon or whatever, this is not the place to find it. This is about the truth, and I'm glad you're here. Let's get into it right away. Beginning with this, hotel brands report major losses in Q3. I think that's pretty obvious, but it just gets into some of that. I wanted to connect it in with what's actually happening, all the important data, not necessarily what MGM is doing and so on, but let's take a look further in. According to PwC, more than half, 58% specifically, of Manhattan hotels remain closed. Findings from the report show that approximately 61,000 hotel rooms in the city had not reopened as of early September. That's a lot. And check this out. Of these, nearly 2,700 are expected to be shuttered permanently. So of course, that's going to have an impact on what we're seeing with the jobs and the economy as a result. You won't see meaningful increases in operating metrics for Manhattan hotels until we see a return of the business traveler, and that likely comes after into 2021, so they say. And this is just showing you one city, but of course all the major cities are dealing with the same thing. New York is especially an example, of course, because we've got major lockdowns, we've got serious things happening there. But of course, you look around, it's pretty much the same thing going on all over the place, and that extends into Europe, that extends other places as well. So that was PwC, and this is this particular hotel and lodging association saying that if they don't get a bailout, well, the industry association expects massive foreclosures, and I do, of course, agree with that. At the beginning of the year, there were about 57,000 hotels across the US. Up to 38,000 of those could close in the next few weeks if Congress doesn't issue more aid soon. To me, that is huge. That is massive. But we don't know what's going to actually happen. We know that there isn't going to be such, massive widespread money flowing from the helicopters in the next little while. So there's going to be issues here. Well, they want more money, they want more aid, they want a bailout left, right, and center. I'm not sure that they can actually provide this, and as a result, there is going to be some problems with the derivatives, as I have suggested many times before. People would say, who cares about this particular industry or that company? And, we don't need to worry about this or that. But let me show you why this is significant and why I have continued to harp on it. New research from Tourism Economics shows the leisure and hospitality industry accounted for 11% of employment in the US, but makes up 36% of the nation's job losses. That is significant. You know that this is one that has been hit very hard, but 11% of employment in this one sector. So of course, you've got a big issue that needs to be dealt with. Recovery is expected to extend into 2023, and without a bailout, as many as 50% of all travel supported jobs could be lost by the end of December. I don't know if that's going to be the case necessarily 50%, but certainly a lot of people will be out of work. Then we have this coming out of the Wall Street Journal. Remember, these are all estimates. These are all forecasts. Nobody knows what's going to happen. So I'm pulling data from these different avenues to try to give us an idea of what may actually occur. So on the left-hand side, we're just seeing a chart, hotel occupancy rates comparing 2019 to 2020. And we are still down significantly, of course, as expected. On the right-hand side here, you're just seeing as many as 25,000 rooms, or 20% of New York's total, might not reopen, analysts and hotel owners say. That's equivalent to the entire size of the hotel markets in Louisville or Jacksonville. I just wanted to note that this information is a bit outdated, but the point I'm trying to make here still remains the same. And that brings me to this. 4 out of 5 New York hotel loans show signs of stress. So yes, we got a problem with the jobs. Yes, these companies have issues. The stocks are a concern, but this is the important stuff. The average investor couldn't care less, but they should be paying attention because we have echoes of the financial crisis, part 1, and it reverberates into part 2. It's still the same crisis in some ways, and this is the continuation. This is a problem here. Let's take a look. But it's fickle, he said. Realistically, we aren't going to see any improvement until the second quarter. The industry is really bleeding. It's not just on life support, it's comatose. And you know that. Look at the chart here. There are serious problems with this particular industry. The lighter blue, it says on the watch list, and the darker is transferred to debt collectors. And it might be difficult to see, but we are up to 80% in this case here, and over 40% for this. And that shows you how significant. Transferred to debt collectors, already over 40%, and that is specifically New York, Newark, and Jersey City lodging loans in the CMBS deals. I told you how significant it was. It's already occurring, and yet the mainstream analysts couldn't care less. Very dangerous advice that they give people. According to figures from TREP, 37, let me write this big here, 37.7% of all New York hotels underpinning CMBS deals now sit on a watch list designed to warn investors of impending trouble before a mortgage is transferred to debt collectors known as special servicers. A loan may be added to the watch list for a number of reasons, such as if the borrower's income had dropped or if they recently missed a payment on their mortgage. We know that this is happening. The rent's got a problem. You know all of the moratoriums and everything that's been occurring, and that's not going to go well as we move into 2021. A further 44.7% of loans have been transferred to special servicers, either to find a way to get borrowers paying their mortgage or to foreclose on the properties. Together, it means that more than 80% of the city's hotels backing CMBS deals, equivalent to $3 billion, are exhibiting signs of strain, more than the national average of 71%. Still, 71% for the whole nation of the US, and you got 80% in this particular area. This is a crisis, and it is brewing before our very eyes. This is a chart from Trepp and Goldman Sachs, where you can look at it specifically. I'm not going to be able to break it all down for you, but it shows you CMBX Series 6 has a high share of retail properties, while Series 9 has a high share of multifamily and hotel. So this is something very interesting, and I find multifamily to be suspicious here because it is generally something that is more affordable for people, and yet we're finding that they're coming up on the CMBS not paying up. Now, I don't know if that's just because of moratoriums and so on, but of course we'll definitely see. If you look at the lodging, it's just showing you that it is quite significant. On the left-hand side, multifamily and lodging properties have the highest delinquency rates among conduit CMBS 2.0 and 3.0 deals. It's just giving you the breakdown, the right-hand side, and also had the highest delinquency rates among the CMBS 1.0 loans during the financial crisis period. And then we have this. The crisis of 2020 triggers the most credit insurance payouts since 2009. I just talked about Bill Ackman, who they mentioned in this article here. And of course, he's going headfirst into this right now at this time. He did it earlier this year. He's not the only one to, but of course, we have people that are making money off of what's been happening, and we are looking at the failures of the system before our very eyes. If you look at this, it talks about the default swaps on 19 borrowers have been settled this year. Low debt recoveries push some protection payouts close to 100%. Right here is where they mentioned Bill Ackman, and they get into the credit default swaps and so on. I'm not going to really harp on about the issue, but just to let you know that this is something that has been surfacing right now, and we have been looking at it. You and I know we're both looking into this information for quite some time. It's been brewing. The corporate debt has been a problem. We're looking at all of the steps along the way, and because it happens so slow, because it's not something that's just overnight, people get burnt out. They think to themselves, I don't need to worry about it. It's probably going to be later. It's probably going to be later. But you will never receive warning. It's not as if you're going to have time, like it's a hurricane and you're saying, all right, well, probably take about 3 days before it gets to us. So we'll prepare and we'll be able to deal with it. It doesn't work like that. It's not like that. And unfortunately, a lot of people are going to be wiped out. Now, what can you do as a result of all of this? You need to hedge your bets. If you are putting everything in full, pedal to the metal, this is taking a big risk. Always have to hedge your bets. And that is something that all of these people, like Bill Ackman here, he's not just shorting the market going 100% in. That's what amateurs would do when they just go 100% of their money into one trade. That is not acceptable under any circumstances. Of course, always hedging your bets. Really quickly, just showing you the chart that's associated with that. The number of CDS auctions rises to the highest since 2009. Not surprising to you and I, of course. And this is the point I wanted to note. Central bank purchases are sapping liquidity out of the bond market, so credit swaps have been the place to be. CDS is having a very active year. The central banks are ruining the system, and we know that. They're doing so on so many levels. It has become very apparent at this time. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. By clicking one button on the way out, you help me out. Thank you very much. If you want to learn how to sell stuff online, I'm talking about e-commerce. You can learn for free at my website, theamazongps.com. The financial system is complex, it's convoluted, but you can actually learn it quite simply in these 2 books. Definitely check them out at the link in the description if you want the audiobook instead, themoneygps.com. Wait a second, don't go anywhere. Have you seen this video? It performs so poorly, it is terrible when you look at the actual amount of views compared to all the kitten videos out there, but I would highly recommend watching it because it connects in with what I talked about here. If you click on it, I'll see you there.